Account Accounting periods should measure taxable income. Tax year may be fiscal year, calendar year, and there's some restrictions. There also include partnerships. Restriction for accounting periods or calendar year equals filings of the dividends. Utilization of 52-53 week year ends last Friday of December. Under certain conditions, partnerships, S-corps may elect the tax year with a deferral of 6 months. All trusts equals required to report on calendar year. Changes in accounting period. Some instances, taxpayer can change accounting periods without IRS approval, even though it's generally required. IRS approval equals taxpayer can change accounting periods with a substantial business purpose, not to save on taxes. When IRS approval not necessary, conformity between newlywed spouses, change to 52-53 week ending, conformity between financial reporting and tax, certain corporations who haven't changed accounting periods in the last 10 years. Reasons for periods less than 12 months. A taxpayer may be required to file a short year return, which is called a stump return. You have to file 0 base return even if no expenses or revenues. Out of business, June 30th to the end of the calendar year is also stump return, and first or final, July 1st to December 31st, 6-month return. Taxpayers must annualize their income expenses. Overall accounting methods, cash receipts and disbursement methods, patient tests are actual and constructively received, taxpayers are generally deductible in the year paid, prepaid expense equals expense based on the years of prepaid expense, accrual method, report income and expense equals all events and economic performance test, hybrid method equals accrual for income, cash for expenses, determination of inventory costs, taxpayers' inventory at the lower of cost or market value as replacement cost. If elect LIFO, must value inventory at cost. Uniform capitalization rules equal inventory. 3 preceding years that exceed 25 million then must go to UCR, which goes to direct materials and labor, manufacturing overhead, factory repairs and maintenance, utilities, rent, insurance, tax recognition, small tools, factory admin, taxes in the factory, quality control and inspection, factory supplement service, rework, scrap and spoilage, pension plan, and profit sharing. Long-term contracts can be under the completion method or completed contract method. Difficult to do completed contract because of restrictions, which are only if company averages gross receipts of 25 million or less, have minimum of 2-year construction. Installment sale method. If gain occurs at least one payment received after taxable year of disposition, installment rules apply. Gross percentage is gross profit divided by contract price. Gain to be recognized of the disposition of the installment. Face amount of the payment 100% minus gross percent. Accounting period equals husband and wife equals married. Husband equals accrual basis equals business schedule C. Or never mind. Imputed interest equals deferred payment plan equals note receivable. Low interest or no interest equals impeded interest. Reallocate the interest on the federal rate. Slow income to the note holder. Impeded interest can be reported on the cash method, sales of personal residence, farm sales for 1 million or less, total loan of 250K or less, related party land sales equal 500K or less, and for certain sales with principal of 2M or less. Gift, shareholder, and other loans. Imputed interest is applicable to gift loans. Shareholder or the office of a corporate loans and partnership selected. Method on tax return equals first year. Select the method on the tax return for the first year. IRS approval generally required to change accounting methods. May change to the LIFO with prior consent. Can't change for omission of income or adding expense. Retail stores can choose January 31st fiscal year ending. Treat the gain for inventory conversions subject to boot. Gains from involuntary conversions may be fully deferred if the full amount of proceeds is invested in quality fine property building to building within a non-taxable exchange equals trading like-kind equipment. Like-kind exchange equals mandatory trade or business. Like-kind property defined as same nature and quality, not its grade or quality. Same class would be truck for truck. A direct exchange must occur, not a conversion to proceeds. Inventory and securities do not qualify. Like-kind exchange with a dealer and buyer. Truck and trade for other truck equals a like-kind exchange. 1036 provide for tax exchange treatment for offset different stock. So common stock to common stock, private stock to private stock of the same corporation. Receipt of boot. Gain is recognized up to amount of boot, which equals the cash or assumption of loss limited by the newly realized gain. No loss on like-kind property. Boot adjusted basis exceeds fair market value. Both properties that are encumbered with debt equals the offset the loan balance. Basis of property received equals like-kind exchange. Basis of property given up less minus the boot received plus recognized gain. Deferred gain equals new property and basis will be fair market value minus deferred gain. Deferred loss equals new property basis will be fair market value plus deferred loss. Exchange between related parties. Like-kind exchange between related parties were disallowed if either of the parties disposed of property within 2 years. Gain will be recognized in tax year of disposition. Exceptions are death, involuntary conversion, non-tax avoidance. Holding period for property received. Holding period of like-kind property includes the holding period of the like-kind property given up. Non-qualifying property. Date is the date boot begins holding period. Involuntary conversions equal a casualty loss. Gains from involuntary conversions may be fully deferred. If full amount of proceeds is invested in qualifying property within certain period, an election is made with IRS. Losses on inventory conversions are fully recognized. Gains from proceeds over the adjusted basis. Government proceeds or severance damages and government proceeds condemnation severance damages are also those. Treat the gain for involuntary conversion subject to boot. Gain is to the extent replacement cost of the qualifying property is limited to the realized gain. So adjusted basis of the replacement property is the replacement cost minus unrecognized gain. Severance damages are paid by the government on condemnation by the city, county, or federal county. If there is a declined value of the retained property, then we are going to reduce adjusted basis and defer it. If severance damages exceed the adjusted basis, then we recognize the gain. Replacement property. Required to be similar or related in service or use to the property so converted. If it is real property and is used in a trade or business or held for investment, and if it is condemned, it can be replaced with less restrictive rules. If it's business or investment, there is involuntary conversion as a result or a presidentially declared disaster. It can be replaced with any tangible property. Obtaining replacement property. Generally, taxpayer must purchase the replacement property. An indirect purchase may be allowed by purchasing 80% control of corporation owning replacement property. Time requirements. General placement is 2 years. Also is after the end of the tax year in which the involuntary conversion gain is recognized. Condemned real property held for the use of trade or business can be replaced in 3 years at the end of the tax year. Also had to do with gain realized. Sale of principal relations. Individuals may exclude up to $250,000 of realized gain married file single or single. May exclude up to $500K of realized gain from married file jointly. Taxpayers are required to have owned and occupied the principal residence 2 of the last 5 years. Section 121, you can have this exclusion available at any age, no replacement residence required. Any realized gain on the sale of principal residence in excess of the exclusion, then we have capital gain. No loss recognized on the sale of personal residence. Determining the realized gain is the amount realized for which it exceeds the adjusted basis of the principal residence. The adjusted basis of the residence at the time of the sale is the original basis. Could be cost, inheritance, fair market value, or gift. We are going to be using the fair market value. It can also be a condominium, mobile home, house, boat, but it must have a bedroom and a goalie. Sale of one principal residence within a 2-year period. Pro rata exclusion may be available for sales, but do not meet the 2-year rules, and multiple sales are due to changes in employment, health, unforeseen circumstances, death, divorce, or having twins. Involuntary conversion of a principal residence, treated under the same rules for involuntary conversions. Then we are going to adjust the basis and defer the gain. AMT is a separate tax. Calculate AMT exceeds the tax liability. AMT consists of taxable income plus preference items, included non-deductible losses and personal exemptions. AMT exemption amount is $109,400 for married file jointly and $70,300 for head of household single and $54,700 for married file single. AMT preferences are excess depreciation over straight line, tax exempt interest, private activity bonds. AMT adjustments, limitation on itemized deductions, adjustments for timing differences, itemized deductions that are not qualifying, real and personal property taxes, home interest. Computation of self-employed tax is revenues minus expenses and cannot take self-employment tax out of that. Self-employment income includes partnership income, distributed shares, plus guaranteed payments. Adoption credit limit is $13,810. The child tax credit is $2,000 per child. American Opportunity Tax Credit is a max of $2,500 of tuition and fees available for the first 4 years of post-secondary education. Lifelong Earning Credit is 20% credit against a $10K maximum of tuition and fees. You can't take both. You must take American Opportunity Credit first if you are a lifelong undergraduate. Payment of taxes. Employed required to withhold FIC Medicare, not for independent contractors. Compensations are salaries, commission, fees, bonuses, termination payments, and vacation. Estimated tax payments on quarterly basis have tax due on the year less than $1,000. Penalty if pay 90% of the current year. Section 1231, Relationship to capital assets. Depreciable property and real property used are not capital assets. 1. The recognized gain from the disposition of property would appear to be ordinary income. 2. Rather than treating the property as capital gain property. B. However, net gain from the disposition of Section 1231 is treated as long-term capital gain. 1. Long-term holding period must be met. 2. Generally from a sale, exchange, or involuntary conversion from the following depreciable personal or real property used in trade or business from the production on income, machinery, equipment, buildings, land, timber, coal, domestic iron ore, livestock held for breeding, dairy, sport, patents, and goodwill. 3. Certain recapture provisions must be met as ordinary income. 4. May also apply to involuntary conversions. C. Depreciable property and real property used in trade or business results in a net loss. Then 1. Treat the loss as ordinary loss rather than a capital loss. 2. Ordinary losses are fully deductible. Section 1231 requires netting of Section 1231 gains and losses. A. Result is a gain. It may be treated as a long-term gain. B. Long-term capital gains are netted against the long-term capital losses. C. General procedure for netting Section 1231. 1. Step 1. Casualty netting, which is casualty gains, result when insurance proceeds exceed the adjusted basis of the property. If the casualty gain exceeds casualty losses, add the excess to the other Section 1231 gains for the taxable year. Step 2. The netting is after adding net casualty from Step 1 to the other Section 1231 gains and losses, then net all Section 1231 gains and losses. If the gains exceed the losses, the net gain is offset by the look-back, non-recaptured Section 1231 losses. If the losses exceed the gains, all gains are ordinary income. Section 1231 asset losses are deductible for AGI. Step 3, Section 1231 look-back provision. To the extent of non-recaptured net Section 1231 loss, the current net Section 1231 is ordinary income. Non-recaptured net Section 1231 losses are losses that have not already been used to offset net Section 1231 gains. Only the net Section 1231 gain exceeding the net Section 1231 loss carried forward is given long-term capital gain treatment. Section 1245 recapture. Section 1245 requires taxpayers to treat all gain as ordinary gain unless the property is disposed of for more than its original cost. The result is accomplished by requiring that all gain be treated as ordinary gain to the extent of the depreciation taken on the property disposed of. The excess of the sales price over the original cost is the Section 1231 gain. Applies primarily to non-real estate properties such as machinery, trucks, and office furniture. Does not apply to if the property is disposed of at a loss. Generally, the loss will be a Section 1231 loss unless the form of disposition is a casualty. Section 1250 recapture. Section 1250 is depreciable real property, principally buildings and their structural components and leaseholds that is not subject to Section 1250. Only additional accelerated depreciation over straight line depreciation is not recaptured.